Romaine Bostick here from Bloomberg Television. A great start to day two of the Bloomberg Invest Global Summit. Of course, we just heard from Michael Arrighetti there, of course, and Greg Jensen over at Bridgewater. We have an impressive lineup ourselves right now for this panel. David Hunt, of course, the CEO over at PGIM. Hynes, of course, the CEO over at Wellington Management, and Julian Salisbury, global co-head over at Goldman Sachs Asset Management. This is a panel, of course, about the future of asset management. So let's get right to that future, specifically the long term, specifically earning returns long term, protecting against downside risk long term, and doing so in an economy that may be maybe lower growth with higher rates. Let's start there. And I want to start off with you, Julian, on that question.
Look, it's obviously an environment where we're seeing heightened valuations by any real metric, both in the public equity markets, rates at near historic lows, credit markets compressed. So, look, it's a tricky environment to navigate. I think what you need is the more active approach is what we're finding is assets where we're really able to implement and generate alpha through touching the assets, whether it be private equity, more hands-on real estate type investments, things where you're less reliant and less sensitive to small rates in equity market moves and credit market moves. But I also think just diversification is key in an environment like this. I think, it's always hard. I think about it at the end of every year, we start about a process of how are we going to generate returns for the coming 12 months. And, I think each and every year for the last 20 years, I can remember business planning. It feels hard. It always feels hard. And the reality is if you have a broad investing platform, super high quality investment teams, there are always opportunities to generate returns, however challenging the market. You have to pivot, you have to change, you have to be agile. But there are always, I can't actually remember a year where people sat down there at the start of the year and thought it's going to be easy for the coming 12 months.
Yeah, well, if they thought it was easy for your jobs, of course, you three, of course, wouldn't be in the jobs that you have here. David, you, of course, are no stranger here to market cycles and sort of the ebbs and flows here that make your job so difficult here. When you talk about asset allocation in a world where, at least to the outside observer, everything looks expensive, how do you sort of position for that?
Oh, well, you're absolutely right, Romaine. It is very unusual. I mean, the dominant theme and context for investing right now is negative real yields. I mean, it has never been more punitive to hold cash. And what that's doing is driving all of our clients to seek out yield wherever they can find it. And for the most part, that's been in, as Julian rightly said, it's been in private markets. We've seen a dramatic growth in allocations to privates. And we do think that the ability to manage for the long term through a lot of those gives them an advantage. When you think back over 20 years, most investors were invested in either stocks or bonds, public securities. And you look now at what a sophisticated institution has an ability to be in, from all kinds of different versions of private equity to versions of real estate debt, real estate equity, infrastructure. The range of private credit has never been broader. So we're able now to offer our clients a diversity of private assets that simply weren't on the cards the last time we were in this situation. So that's really where we're spending a lot of our time with our clients.
I'd like to get your thoughts on this as well, Gene, and I think David hit on a great point here about you go back to what asset management looked like years ago, if not decades ago. It pretty much was just stocks and bonds, stocks and fixed income, and the universe now almost seems infinite.
So I would add, one of the things I would add to the commentary that Julian and David just talked about is the fact that this is going to be a market. This seems like a market where differentiated skill, like real research-based asset management, is going to maybe have an advantage versus maybe the last 10 or 15 years. And whether that's in liquid alts, long short, whether that's in the private markets, whether that's in the long only markets, which I still believe have an incredibly important place in the asset allocation of our clients. And if you can deliver alpha above a benchmark, that has the ability to compound, and that's still the vast majority of where our clients are allocating their capital. So I would add that active management, I think, is going to be more important in the next decade in the past. So we're investing in just attracting lots of capabilities across the whole spectrum of capabilities in asset management. I think the other thing I would say is if you look at the big macro picture where yields are and valuations are, I think there's a lot of diversity happening below that, a lot of diversity happening, between sectors and between stocks. So there's still a lot of opportunity. That again leads to how do you want to be positioned from a research-based perspective. Sustainability is going to be incredibly important, and I think we can talk more about that. That's a micro issue. That's going to be stock by stock. How ESG factors are impacting each stock. And then maybe the final comment I will make is that we are still in a tremendous, there's still a tremendous amount of innovation happening around the world. And so how do you balance that with where valuations are now? The numbers of private companies and we talked about the private markets, and the private markets are attractive because there are just a tremendous amount of private companies being created across all categories of the world. I'm a healthcare specialist. The number of biotech companies being created is just really higher than it's been in my 30-year career following the sector.
I am curious, though, but with regards to the growth of some of these private companies, these sort of new sort of era companies, and whether they actually do come to the public markets. There are some people that look at these companies, they say it's a great opportunity. If you can afford to pair up with a Wellington or a PGIM or a Goldman Sachs Asset Management, that's great. There's a whole investable universe of people out there that don't have access to that. Is there a bridge between those two?
I think absolutely. I mean, I think what we're going to see over the next 10 years or so is democratization of alternatives, easier access to alternatives. Alternatives, you're able to generate returns because of the complexity of the investment process, because it's a very hands-on approach to source the assets, to impact the assets, to drive value creation into the assets. That's why you generate the returns through alternatives. Doesn't mean you should make the process of investing in alternatives as challenging. We need to make that as seamless as possible over time. And I think that's going to require a couple of things which all speak to the need for scale. One is huge investment in technology to be able to deliver alternatives in as seamless a way in the future as it is to buy a stock today. I mean, at this point in time, for the average person to get access to private real estate, private credit, it's a multi-week, multi-month process of getting on board, it's subscribing, the reporting's delayed. It needs to be driven to the point where at the click of a button, you can get access to these products same day and real-time reporting on what's going on at the portfolio level. And that's, I think that will result, we're seeing evolution in the wrappers that are available to make alternative products available to a broader range of people, smaller chunk sizes, tokenization, subject to regulatory overlay will drive that down further over time so more people can access it. But I think this will become, as obvious an asset class to people, as an accessible asset class to people over the next 5 to 10 years. And I think that trend seems to be accelerating.
Yeah, David, can you talk about that accessibility, or at least the move towards more accessibility?
Well, I fully agree with Julian. I think one of the things that we all need to focus on as an industry, and we'll need some help from the regulators in this as well, is how do we make those excess returns in the private markets available to Main Street? Because right now, most of that we're all offering to our institutional clients and some high net worth, but actually through broad retail channels, it's still quite challenging. And through technology, but also we'll need some regulatory help to be able to make more of these accessible. But I think that that's actually an exciting challenge, and I think it will open up a whole range of diversification possibilities for retail investors that they don't have today. Because the retail investor is still largely in that they own either stocks or bonds. And we need to make sure that they have the access to the same suite of asset classes for diversification and return that an institution has today.
Some would say, though, that one reason why we don't necessarily have that just yet is because of the risk, or at least the relative risk with some of those investments, as well as the research or lack of research that's available to a much broader universe of people out there. Do we get to a stage where we start to see a little bit more balance in that area, Gene?
Well, I think we're probably far away from seeing that on the venture side. So if you think about what's happening in private markets, it's the spectrum of what assets or companies are in private. Some are very, very early. There are a lot there. Some of the venture firms are starting companies. Some are very early. I think that's far away from the ability probably for retail investors to own that. As you get closer to the public markets, and you've seen this trend where companies are staying public, staying private much longer. Some of those would be public companies. Those companies, and actually, the interesting thing, to be able to follow public companies now well, to follow an industry well, you actually need to know what's happening on the private side. So you probably will need to see, you'll probably see more access to, public investors or sell side researching the private companies because they impact the industry dynamics of a sector. So I think that will become more accessible as well.
I think that's a really important point, Gene. And I think that, Romaine, to your question about the structure of the asset management industry, this is where we're seeing a fundamental change. So again, if you were to go back 10 years, there were alternative players and they did private assets, and there were long-only players and they basically played in the public markets. And what you're seeing, and you can see this in the business models of my colleagues on the panel here, now we all have to be in both. And successful asset managers will do both public and private markets, and very successful ones will integrate the skills between those to come up with better investment ideas. And that's a big change in an industry that has grown up in two very separate spheres.
That's a great point, too, particularly with the model, PGIM's model and the partnership model, smaller partnership model that you have. I am curious, and I'll pose this to Julian because you actually, I think, raised this point here about consolidation in the industry and whether there is even room anymore for that type of sort of monoline asset manager of old.
I think it's like many industries. I don't think you want to be stuck in the middle. I think you have to decide, are you going to be a scale player offering all products or the majority of products globally to your clients in whatever wrapper they require, so that you can serve a broader range of customers globally and deal with all of their solutions. If you look at our platform today, we have everything from money markets at one end through to secondary private equity at the other end in terms of the liquidity spectrum, and the ability to bundle that, wrap it, deliver it to people in a customized way, I think will be increasingly important. And the only way you can do that is to do it at scale with a huge technology resource behind you. I think there's going to be room for many years to come for smaller boutique players who are hyper specialized and can go deep, and they just do one thing really, really well. I think that will persist for some time, but I think to be somewhere in the middle is going to be increasingly challenging. Where we still have 100 asset managers with more than $100 billion. We have 20 with over $1 trillion. I think you'll see that continue to consolidate further, so that people can spread the cost of investment that's required to do this well over a broad base. And just one other thing on consolidation that I think is important. There's a danger. I think some people might perceive being big as being bad or detrimental to returns. I think you can be big as a platform without being big in or overwhelming individual asset classes or investment themes. So if you have a broad-based platform, you can invest in the platform, and then sitting on that platform, you can have different strategies, different managers. Some can deploy large amounts of capital, some can deploy smaller amounts of capital, depending on the underlying opportunity set. But it's the breadth of the overall platform that's critical from a technology, from a distribution perspective.
So I would say, Romaine, that our multi-manager is the solution to this conundrum that you described. So if getting larger in an individual strategy or in an asset class does mean fewer and harder to find returns, and I do believe it does, but you need to continue to invest in the overall platform as a trillion-dollar manager. Our solution is for our individual asset classes, to keep those to feeling like they're a partnership and very focused and very tailored around their individual asset class. But then when it comes to brand or technology or some forms of distribution, I invest as a trillion-dollar manager right around the world. And so we hope we get the best of both, of being small and focused with the investment being large. Because I think if you go with just large and integrated, you begin to lose your edge as an investor.
Yeah.
Jean, you're a trillion-dollar manager.
Yeah, so I would say we are large and integrated. So we've grown organically for our, we've been a private partnership for 42 years and grown organically to about $1.4 trillion in assets. But that, if you go beneath the surface of Wellington, that's 60 teams. So 60 teams that are globally integrated with an open collaborative platform where we share research. It's sort of a marketplace of ideas. So not separate companies, one global integrated platform. But I completely agree with David and Julian that scale is important. Particularly I think in in the next decade versus maybe the last decade or the decade before, and that's technology, as we've talked about. If you think about how sustainability will impact the markets, that's going to be a data game. Data will be incredibly important to getting sustainability investing right over the next decade. So you do need to have the resources for both of those, I think, to be competitive in the next decade. And many of these new asset classes, privates, liquid alts, they require more, they're more operationally complex. So that's another area where you need scale investment. But I think the last thing I will say, but alpha is rare. So alpha is not a scale business. And I think David mentioned that. So you need to keep teams and individual teams, and we call them boutiques here at Wellington. You need to keep them small and nimble, and to be able to invest in small groups to really create the alpha.
I want to get to a couple of viewer questions here. One we have from Marianne from Zurich. She specifically wants to know about some of the regulatory issues out there, particularly regarding disclosure requirements and some of the disparities that we see between public and private companies, and how that, if at all, can be addressed. Who wants to take that?
Look, it's an interesting question as you force private companies to increase disclosure and you start creating mechanisms for liquidity. There is a secondary market for growth equity stakes. There is a burgeoning kind of increasingly, I wouldn't call it liquid, but there is a market for for private equity stakes. There are markets for many of these private assets, and at some point the lines become blurred between what's public and what's private. I think the key thing for us when we're investing in private markets is, because you're able to go forensic, get under the hood, really take the engine apart, it gives you a higher degree of confidence to be able to look at longer term projections that you're just not able to present to the public markets. So I think that's a key differentiator. But I think just back on this regulatory point, one of the challenges I see here is we would like more people to have access to the higher yields available and the higher returns available in private markets. The democratization of alternatives, I think, would be a good thing to see. And one of the things that makes it challenging is right now, the regulatory requirement to ensure liquidity is available to the investors in the vehicles. When you're investing in an asset class, the underlying asset class is inherently illiquid. So you end up with this mismatch between the liquidity of the liability structure and the liquidity of the asset side. And liability mismatches or liquidity mismatches are a dangerous thing. So I think we have to try and start to move towards a model where people who are investing in an inherently illiquid asset class understand that it's inherently illiquid and are willing to accept lower liquidity provisions than might have otherwise been the case. Otherwise, they're almost guaranteeing themselves suboptimal returns.
Mm-hmm. All right, another question. This is from John in London, and he has a question about the SPAC boom and how it's affected your allocation to capital, and whether you see SPACs as a vehicle, as a longer-term feature of the investment landscape. Jean?
Yeah, so I would say we're not offering SPAC vehicles to our clients, but we're investing in SPACs if they represent good value. And I would say that's again based on the research. Do you believe in the owners? Do you believe in the people who are raising the money that they will be good allocators of capital? So in some ways, it seems like there was a boon of SPACs. Maybe that will take a breather, but as a vehicle, it's likely to be a vehicle that will be around for a long time. And you need to know who's running the vehicle. Are they good judges of value in companies and innovation, so that you have the ability then, if you're an investor in SPACs, to make good returns over time?
But I think, Romaine, the main lesson from what we've seen in SPACs is just how difficult it is for companies to go public. Right, so we have almost half the number of public companies now that we did 20 years ago, and companies, as Jean pointed out, are more and more choosing to stay private. And I don't necessarily think that is a good thing. Partly until we get to democratization of alternatives, that means that excess return is being captured by institutions. So at the moment, it's very clear that the public market IPO process is not as efficient or as easy as people need it to be. And that's what's given rise, and we can argue whether SPAC is a good thing or a bad thing, but it certainly had a lot of demand, and a lot of people have chosen to take that route. And I think the lesson there is we do need to go back and make it easier for companies to go public. And I think that's going to be critical for the health of our public markets.
Maybe I'll just add a couple of things.
Go ahead.
Yeah, if you don't mind. Just add to David and Jean's comments. I think the SPAC product or SPAC wrapper is a perfectly fine solution for companies. I think it was a solution that was overly exploited in the early part of this year, where there was just too much euphoria around it. I think it's a useful solution for a seller of an asset. Not only because they're able to get to the public markets, but often able to achieve greater secondary liquidity than is possible through a traditional listing. They're able, as I mentioned earlier, I think, to use projections, which for many growth type companies, it's pretty hard to evaluate them without a more comprehensive set of forward-looking projections. So there are some. I think it's a useful solution. It's a useful product to have in the market that was just used, too ferociously in the early parts of this year. I think just given some of the economics around those wrappers, and that will no doubt lead to some companies going public that weren't yet ready to go public. There'll likely be some disappointments over the next few months, and I think a kind of pause here and a period of consolidation in the raising of these SPACs, I think, will be healthy for the overall market.
This also raises a question here about the types of questions you're getting from clients with regards to alternative or newer assets, including cryptocurrencies and things that maybe fall outside the general purview of what we would consider, I guess, relatively safe, or I guess maybe a little bit more volatile than what you would get within the norm here. What's your general approach to addressing those types of client questions and potential allocations to those types of assets?
Well, I'm happy to start. I mean, I think that if you take again the broad picture of the economy, ever since the great financial crisis, where banks all of a sudden had much stronger regulations placed on them, the economy overall, and particularly global flows, have largely come through the securities markets, whether there be public or private. And so the overall intermediation of capital between saving and investing has never been more tilted toward investment managers and away from banks than it is now. What that's done is provide whole new asset classes. Private credit is probably the best example in all of its forms, from obviously some of the securitized pieces of it to investment grade, all the way down to direct lending. And our clients see these areas as new and diversifying potential additions to their portfolios. And they're actually very interested in finding ways, particularly given our yield environment, of putting more money to work in all of those areas. And most of them believe that this trend away from banks being the provider of a lot of that capital to the middle market is here to stay. And they are very happy to step into that void.
Anyone else?
I
Yeah,
might
look,
add that you have both the cryptocurrency itself, sort of whether it's a currency or a commodity, you have stocks related to that, so that's an opportunity. And then if you take a step back in the asset management industry and the finance industry in general, how will blockchain and other forms of this technology impact how we trade? That's something we're studying because it could really change how trading is done. I don't think in 21 or 22, but over the long term, it's important for us as an asset management industry to see where blockchain is going in terms of how we operate as a firm. And I completely agree with David that we have clients that are interested in it, but I would say it's early days, intriguing, but early days in terms of an asset class.
Maybe just to briefly
Julian?
add to Jean's comments, I think it's a bit of a wake-up call when you see the pace of development for some of these cryptocurrency businesses. I mentioned this earlier, the fact that we need to move to a model over the next 5-10 years where we can deliver traditional asset management products, both traditional and alternatives, to clients in a more seamless way. Today you can open a crypto trading account by scanning a photo of your driver's license, have an account open in somewhere between 30 and 45 seconds, and be trading 30 to 45 seconds later and be selling again, 45 seconds after that. It's really raised the game in terms of clients' expectations around how we deliver products and services to them. And I think if you look at this generational shift that's going on right now, where, the Gen Z is going to overtake millennials in terms of the bulk of the wealth in this country over the next 10 years, their expectations and demands around service, customization, being able to make their own decisions on a timely and quick basis, they're embedding their own philosophy and beliefs into their investment process. I think it's all going to drive towards more customization, and that's going to require, as I said earlier, greater investment in technology. And I think tokenization and or blockchain technology will help facilitate that.
We only have a couple minutes left, but Gina, I actually want to get your thoughts on that too, particularly on his comments, Julian's comments here about some of the generational differences here. This feeds right into the whole debate about active versus passive. There seemed to be a certain generation out there, maybe my generation, that gravitated much more towards passive investing. But you're actually starting to see the newer generations, the Gen Zs, actually seem to embrace the active side maybe a little bit more than what we saw with Gen X and maybe some of the older millennials.
So, and I think that's driven a lot by what's going to happen with ESG. This generation is incredibly dedicated to sustainability around, sustainability in all aspects. And so that is an area where this generation will have higher expectations for their asset management companies going forward, in an area that I think they will be a force that will change the structure of financial markets from a sustainability lens. Just as factors have done in the last decade, value or momentum or growth, ESG factors are going to change the structure of the markets going forward, particularly as you have 5,000 companies going through their own net zero paths over the next decade. And this generation is incredibly focused on that.